Morning, everyone. I'm Jamie Card, partner and financial institutions team leader here at the Bonadio Group. I'd like to welcome and thank you for joining us for today's webinar. Before I formally introduce the guest speaker, Nicole Booth from Elliott Davis, I'd like to call your attention to the housekeeping slide and note that throughout the presentation, you'll be prompted to answer polling questions to ensure that you receive CPE. During the presentation, if you have any questions, go ahead and send those via the chat, and I will present them to Nicole to answer throughout the presentation. Bonadio and Elliott Davis are both members of the More North America Alliance, and throughout the Financial Institutions Community Group, we've recently developed a working relationship, and this seminar is hopefully the first of many that we'll present. I would now like to welcome and thank Nicole Booth, Senior Manager at Elliott Davis, for joining us today. Nicole is a certified anti-money laundering specialist, has more than 15 years of banking experience, and brings a specialized proficiency in Bank Secrecy Act, anti-money laundering, and regulatory compliance. Before joining Elliott Davis, Nicole worked for both large and smaller community banks as a BSA and compliance officer and performed due diligence reviews in the fintech space. We are excited to have her here today to provide us with an overview of the 2021 BSA AML landscape. And with that, I'll turn things over to Nicole.
Thank you, Jamie, and thank you all. I'm so happy to be here with you all and talking about BSA in 2021. As Jamie had mentioned, please feel free to jump in with any questions. Certainly within the last year with the pandemic and the different landscape, we've been more virtual than we have been in person, obviously, and speaking to myself for an hour isn't my favorite thing. So if you have any questions, please jump in and we can have more of a conversation. We're going to jump right into the future of banking. I know that when we talk about the future of banking, a lot of times we think about fintech, financial technology companies, and how they're disrupting the financial industry. We think a lot about the different technologies that they're bringing. We think about machine learning, artificial intelligence, and we also think about the challenges that they bring to to traditional financial institutions. A lot of the challenges that they're bringing include a difference in what our consumers have for expectations. They're now looking for streamlined services, where in the past, they looked for financial institutions that were really able to provide all of their financial needs to them. We talked a lot when I was in banking, we talked about sticky services. We talked about increasing the amounts of products and services our consumers had. It was more difficult for them to move from financial institution to financial institution because of how difficult it would be to change those services. That has completely changed, especially with the new generation of millennials and Gen Z in the financial institution services. They're really not committed to the idea. They're okay with using as many financial institutions as they need, as many products and services that they need, and they're quick to move to new technologies as they come out. Their heightened consumer expectations have put a lot of pressure on banks to also really come out with new technologies to compete with the financial technology companies. With those challenges, though, there have been a lot of opportunities that have been gained as well for financial institutions. More and more, we see financial institutions partnering with fintech companies, whether to allow them to utilize their services, to extend services to consumers, or to partner with them directly on different services and products that they can offer. We're going to go ahead and jump into some of the technologies that they're providing and how that's changing our landscape. The first is conversational banking, and this is one area that we've already seen deployed across many financial institutions. If you're online and you see that chat box pop up, that's a bot that's talking to you. They're picking up on what you're asking for. That's machine learning. That's artificial intelligence you're speaking with. We also see customer insights already being deployed, where data is being analyzed to determine what consumers, what their trends are, what they're looking for, how they're spending their money. And you're able to take that information and really develop new products and services to offer. We've also seen it deployed in detection of suspicious activity, being able to identify based off of trends that you've seen or trends that are out in the industry for suspicious activity, and being able to apply it to your transactions and being able to determine when suspicious activity has occurred to enable more streamlined suspicious activity reporting. And what we're seeing now is it also being deployed from a preventative perspective. And that's something that I think we're going to see more and more as an expectation, especially with the new AML rules that were recently enacted last year. We're going to see more predictive requirements and not just being able to detect suspicious activity, but also being able to prevent it. We're also seeing customer identification. Fintech companies have been doing this, and now we're seeing other traditional financial institutions really taking on when it comes to digital banking and being able to open accounts online. We're looking at that process and seeing that customer identification through AI and machine learning, being able to see someone's ID, detect that it's a true identification type that they expect that their customers are going to be providing, and being able to identify their customers. And then we're also seeing some new technology and operational automation, where we're seeing that deployed, especially in lending, when it comes to underwriting for consumer loans and for mortgages. We're also seeing operational automation in controls in the back office, being able to heighten dual control and compliance requirements. When we're talking about digital banking and some of the benefits that come along with it, we're seeing financial institutions being able to connect more with their consumer, which seems odd that we're going to more of a digital space and being in person, where we're seeing additional connections there. But those connections are being created by leveraging that data analysis, being able to really be predictive on what their consumers are expecting and what their needs are from financial services. And that lays into being able to predict what their consumers are going to need. One thing that financial technology companies have been able to do really well, where they really started, they identified gaps in the marketplace and then created solutions for those, where traditionally banks have rolled out products and services that would benefit the majority of their consumers. They looked to meet the needs of the full population rather than trying to identify a very specific or unique need. We're seeing that change with financial institutions, traditional financial institutions, with this prediction, being able to predict what their consumers are going to need and being able to adapt and roll out new products and services. Where fintechs have traditionally met that need within the marketplace, really being able to identify one product or service and doing that well, we're seeing an explosion of financial services that they're now offering. And one of those is the banking as a service, the neobanks. We're seeing where they're providing essentially a digital banking experience where you have your traditional checking and savings accounts layered with other products and services, add-on values that we typically haven't seen before. With fintech companies, they're offering services like payments, lending, investments, and insurance, and they're creating a full opportunity financial institution where they're seeing, with traditional banking, where you've had your consumer really being invested in all that your bank has to offer, we're seeing that now with fintech. So they've kind of starting to pivot, and instead of being that niche service, they're trying to be the full service offerer. I wanted to talk about partnering with fintechs. We're seeing more and more of that with banks. And some of the benefits that you have with partnering with a fintech, it may be where you're allowing them to utilize your services to provide their services. Of course, fintechs are not chartered financial institutions. They will need, they do need banking services. And so we're seeing where financial institutions are offering that, allowing them to come in, sponsoring them. And then we're also seeing where they're partnering with fintech almost as a vendor to be able to provide additional services to their consumers that they have. Some of the benefits to that is being able to leverage reputation. That could be on the banking side or it could be on the fintech side. They're also leveraging consumer base, where banks have traditionally been limited to where their physical footprint is. With digital banking, partnering with the fintech, you've now opened yourself up. You can be domestically across the US and not have to worry about growing due to acquisition, merger, or opening up a new location. You now have an expanded footprint with the fintech services. Of course, being able to leverage the technology that the fintechs have created with their automation, the AI that they're using for customer identification, the new products and services that they're offering, leveraging those and being able to offer that to your consumer base. And then also the scalability. You have the ability to really determine how quickly you want to grow, which products and services you want to roll out, and how to really ensure that you are being considerate to the risks that are there, the compliance. So you have that increased partnership there from a risk management perspective. And how banks are partnering with fintechs from a true partnership perspective is through banking. We talked about the neobanks and how they're offering the full range of services. There's also partnerships within lending where we're seeing, again, increased consumer base where you're able to offer additional lending products, whether it be in mortgage, SBA. We see that as probably one of the highest or fastest growing areas where banks are partnering with fintechs. And then also with other consumer loans, personal loans. A lot of the automated underwriting services, banks are leveraging fintech's methodology for underwriting and for being able to onboard consumers in a digital landscape. And then we're also seeing it with the add-on services. So features like rolling up transactions to be able to move those funds into a savings account, automated investing options, different services for line of credit or for overdraft. We're really seeing banks partnering with fintechs to be able to provide those add-on services. And of course, if we're talking about the future of banking, we cannot forget about blockchain. We're seeing more and more of blockchain being brought into the financial industry and how we're changing the way that money is really being moved. Some of the benefits to blockchain include streamlined and accelerated financial transactions. These transactions are settling much quicker. You have your record of, as you can see here from the diagram. We see increased security over cyber threats as well by integrating blockchain into financial transactions. And while this technology has certainly been around and has really been associated with cryptocurrencies, we're seeing blockchain come in outside of that and being utilized with your traditional wire transfer or other ways of moving funds outside of just being associated with cryptocurrency. And so that's something to certainly look out. I know that there are a lot of financial institutions that have already started to adopt blockchain technology into some of their digital services. And we did get a question that came through on the expectation from financial institutions in reference of the BSA/AML Act in future audits. And that is a great question and a topic that I spoke on not too long ago. One of the largest trends that I saw with the AML Act was increase in technology. They're looking for, again, I kind of spoke to that with really being predictive in your transaction monitoring. But the AML Act is really asking for not only for FinCEN to increase their data analysis of suspicious activity reports that are coming through and to increase that communication back to financial institutions, but they're also looking for financial institutions to really ensure that they have proper transaction monitoring in place. The AML Act is really pointing to the SAR. Everything, I think, when it comes down to examinations, it's going to start with your suspicious activity report. And there's a lot of language within the Act about the suspicious activity reports being valuable to law enforcement. And so kind of backing into that, making sure that transaction monitoring is in place, that you're utilizing technology. The Act wants FinTech, wants banks and for FinCEN to adapt to new technologies, and for FinCEN to really provide additional guidance around model validation for transaction monitoring. So I think that that's certainly one expectation for the exam is really it's going to start with a suspicious activity monitoring, or start with suspicious activity reports and back into monitoring. So ensuring that you've got your model validated, that you've considered all risks, and that you're producing suspicious activity reports that law enforcement deems to be valuable. And with that, we have our first polling question.
All right, I'll launch the first polling question, and just remember that in order to receive CPE, you'll need to respond to all 3 questions that are within the presentation.
We are going to jump into detecting suspicious activity and how that has changed with the impacts of COVID. We were just talking about, the future of banking. We're talking about technology. One area that I've definitely seen outside of the driving force of fintechs and the competition there between traditional banking and fintech companies, we did see financial institutions really pivoting quickly, having to embrace technology in order to continue to provide services to their consumers. And so now we're seeing where that technology is really being brought into other areas to financial institutions, including suspicious activity monitoring. So with COVID, the first part to really updating your program is to identify your risks. What risks does your financial institution have when it comes to a lot of the financial crimes that have come about or increased with the pandemic? If you are not a PPP lender, you're most likely still acquiring PPP funds. If your consumer has brought their the funds that they've received from a PPP loan to your institution, whether it was directly deposited or if they've transferred it over. And then, of course, the increase in government benefit fraud. That's definitely been, I think, a huge component to the fraud that we've been seeing in suspicious activity reports that are being filed, especially if you're not a PPP lender. So identifying where your risks are from the impact of COVID, and then ensuring that your monitoring systems have been updated to really be able to detect that activity, able to prevent it, fantastic, but at the minimal, being able to detect it. And if you don't have a monitoring system in place, what other resources do you have? Or even if your monitoring system has not updated to include being able to detect for that type of suspicious activity. I know some models like Verifin, they came out with a lot of great parameters to be able to detect COVID-19 related suspicious activity. Some vendors did not. And so how are you bringing that into your system? Are you able to create additional parameters if you have more of a flexible system, or have you been able to add additional resources or utilize the resources that you have to be able to detect and file on suspicious activity? And really looking at the trends, there's a lot of information that has been provided publicly to be able to see. There's a lot of cases for PPP fraud, how other financial institutions, again, even if you aren't a PPP lender or weren't the lender when there was fraud in that area, how other institutions were used. There's a lot of cases out there that the DOJ shared. And then, of course, how government paying benefits are being utilized, and we're seeing the fraud there. Being able to ensure that you're aware of these trends and being able to adapt again to your resources or your monitoring system to ensure that you're detecting that suspicious activity. We're going to focus a bit on PPP loans and the fraud there. So here I have some statistics for you. As you can see, a lot of lenders, a lot of funds, and a lot of red flags. One area when I work with financial institutions on PPP loan and fraud, there was an expectation that because of the streamlined process, the goal was really to get funds out to businesses that needed it as quickly as possible, and there wasn't a huge burden of due diligence on financial institutions. That was the expectation in the beginning. We saw that pivot pretty significantly with the DOJ, their investigations, and examiner expectations as well when they're coming in, and if you've had fraud. And so, certainly filing SARS was the expectation if you detected fraud, but what that also caused then was additional scrutiny on financial institutions and to really determine if there's any negligence there when providing those funds. And of course, reputational risk, as we said on the last slide, there's a lot of cases out there that are available for you to learn from, but what that also did was throw a lot of financial institutions out into the public view, not really understanding what the expectation was on those financial institutions for conducting due diligence and getting the funds out quickly. That was fantastic. There's a lot of people who needed those funds, but it definitely created for financial institutions that burden of, okay, now the funds are out there and our name is out there and being associated with fraud, that we were duped and that we did not do our due diligence. I saw a few cases where I think there were several businesses that went to the same financial institution and they used business names that all trended with a certain movie or different characters. And so certainly being out there with your financial institution's name as being a part of that fraud, it increased reputational risk significantly. So with that being said, I think even though, again, the expectation in the beginning was not that there was increased due diligence, financial institutions quickly started to implement due diligence for those reasons. And so here are some of the ways that we've seen that due diligence, we've helped financial institutions be able to really increase their awareness and their detection of fraud. Taking a look at the loan log. A lot of this is kind of data analysis that you can employ with resources that you have. Taking a look at the loan log and looking for outliers and identifying high-risk factors. There are, of course, with PPP loans, there were underwriting requirements and really being able to see if you're looking at your log and if you have collected certain information on those loans and you have it, you can take a look and run some filters looking for outliers. For example, a business that essentially with the amount of employees they've noted on the application and how much they say their payroll was, if all of their employees are earning around $99,000 a year, that would be a high risk factor. So just looking at outliers, looking for things that maybe don't make sense and really being able to identify the loans that maybe need to be looked at. Looking at your internal reports as well, of course, SARs that you have, we found where SARs were filed on businesses and how they were using funds, but not traced back to the actual loan, that this started with PPP loans, and the SAR did not make mention to the loan at all. So really taking a look at your SAR log, especially if you're not a PPP lender, that's where we saw that the most. Really being able to trace back, you're able to see if they received a PPP loan and see if those funds were associated with that. Adverse action notices as well. You're able to see where lenders clearly saw that this was a loan that could not be made because they were not meeting the requirements, or maybe the borrower was not providing all of the information that was being asked for, but really not identifying that this was a PPP loan fraud and referring that to the BSA department. So taking a look at adverse actions, that is a great resource for identifying PPP fraud and making sure that you're filing SARs appropriately on that. And then, of course, identifying inconsistencies that goes along with the adverse action, and then also looking through your PPP loan log, just being able to identify those inconsistencies and then filing appropriate SARs. There's a lot of data out there that the SBA has been providing on PPP. So you're able to evaluate trends there. You're also able to see where there were multiple loans made to a similar or same business. And then they also have their system for reward management, SAM, where you're able to see and detect where they've detected fraud, and you're able to make that comparison to your loan log. And then other resources that you have is just visual analysis. Again, going through your loan files, whether you're sampling, if you're unable to perform analysis through reports, utilizing public databases, even just a Google search on the business to see if it's in existence. And then also just analyzing industry reporting metrics that are out there. So you have a lot of databases, again, whether it's the Secretary of State, whether it's the SBA, you have databases that you can utilize to provide additional information for your analysis. And we're going to take a look at some of those data resources that are available to you. Of course, your course system is going to have a lot of information, even if you don't have a quote unquote loan log for PPP loans. If you're able to extract that information out of your course system to create a report that you can then analyze to look for those outliers. Your suspicious activity software, if you're able to extract information from there, maybe incorporate it with some of the information that's on your course system, then you can really do some significant analysis. And then also incorporating SBA loan information as well. Also, the FinCEN filing reports, you're able to see, they provide a lot of information on what SARs are being filed and what the trends are. Census tract data, the active business licenses by state, Secretary of State, and then also money service business listings by state. You're able to pull that information from the database that FinCEN provides. We saw a lot of PPP fraud that came from FinTech in their register as money service businesses in those areas. So being able to pull that down as well. And with that, we have our next polling question. And just taking a look to see, have you made substantial changes to your BSA program due to COVID-19, whether it was having to increase resources, adapt with technology or new analysis, being able to utilize your resources for suspicious activity monitoring. And I also wanted to just check in and see if there's any questions on identifying suspicious activity related to COVID.
We have not received any, Nicole, but please enter your questions in the chat box and either address it to everyone or the panelists, please.
Great. So we're going to be completely switching gears and looking at cannabis. We have to talk about it in 2021 with 15 states fully legalizing cannabis. A lot of the states that I have here implemented full legalization for 2021, and then 36 states have either decriminalized or have medical marijuana laws allowing for medical cannabis. And we're talking about cannabis. We're also talking about hemp as well, included in there. And so I think it's hard to find now a state that is not impacted by some form of cannabis. Again, whether it's recreational or medical marijuana, or if we're talking about hemp and CBD, we're pretty much all impacted now at this point. And making sure that your program is equipped for those risks, regardless if you are engaging directly with marijuana or hemp-related businesses. Your institution is going to be impacted, and ensuring that you have the right controls in place is going to be paramount, especially as you're going into an exam. Some of the areas that I've seen a lot of focus on, especially if you're not participating directly with these businesses, is ensuring that you've included it in your risk assessment. What your risks are, of course, where you're geographically located is going to impact that risk. If you are, especially in a state where adult use has been legalized, that is the risk is there for you. If you are towards the boundary of a state and you are abut to a state that has marijuana legalized, that's going to be an incredible risk to you as well. So the risk that your institution will still be utilized for those services, or that funds will be coming through from a consumer perspective as well, you want to make sure that you're identifying that into your risk assessment. Again, into your transaction monitoring systems as well, how you're detecting that at onboarding and throughout the relationship with businesses and with consumers. And then ensuring that you have controls in place to file suspicious activity reports. FinCEN came out with guidance, of course, that talked about suspicious activity reports. There's 3 reports that you need to be filing if you have if you've detected that you have a customer that's engaged as a MRB, a marijuana related business. And where I do see the gap is with financial institutions who are not offering those services, but if they detect that they have an MRB that at onboarding that came through and they detected it on the back end and closed out the relationship, they're not filing that terminated SAR to follow. So that's one exam finding that I've certainly seen. So again, regardless if you're directly involved, making sure that your risk assessment, your policy, and your controls have all taken this into account. And I think we have some questions that just came in. So one question about what program to adapt to enhance transaction monitoring. We're seeing if you have a model already, and if you feel like it's not meeting your needs anymore, I guess I think I need a little more information on that question. If you have, are you looking for which models to use or to implement additional programs to transaction monitoring? And then another question was, what specific BSA changes will examiners be looking for regarding COVID? it's going to be that you've adapted to this new risk. We talk a lot about risk assessments, and one of the changes that came with the exam manual updates for FinCEN was really pushing, it wasn't a change, but the language changed around risk assessments, and there is no timing requirement to update your risk assessment, but what the requirement is that you do update it when risks change, which are typically, for the most part, foreseeable. If communication is there properly, you know when a new product or service is coming out, you know when there's going to be a change in your customer base because of merger, acquisition, or a new location, or if you're opening up your customer base, if you're allowing for digital onboarding past your physical footprint. You're really able to identify when those risks are coming. This was one risk that no one was able to identify or really prepare for. So how did you change your program? How did you adapt to that? Did you take a moment to see what the risks are that are going to impact your financial institution? Did you include additional monitoring to identify and increase your referrals to be able to report on suspicious activity that was coming through? And how were you speaking to your board about it? Were you having those conversations with your board? We're going to speak to board reporting in a few slides, but one thing that I'm constantly reminding my clients about is what the board's role is for suspicious activity reporting and for BSA altogether. In order for them to meet the responsibilities required of them for BSA and AML, they have to have the information, and that comes from BSA officers. So ensuring that you're communicating risks, ensuring that you're communicating how you're mitigating those risks, and any additional resources that you need, that I think is another area that examiners are going to be looking at.
And Nicole, we did receive some clarity on the prior question. This person is seeking, they currently have a manual monitoring program, but are seeking an automated process in order to reduce human error. Can you comment on this updated question?
Yes. So I'm so sorry. When you say human error, I assume that you mean within the transaction monitoring and not within recording of information. But if you have a manual monitoring program in place, utilizing even just Excel, again, being able to download or pull reports out of, whether it's out of your core system, pulling information from public databases and integrating them together and being able to analyze and looking for outliers. Excel is a great program for that. If you don't have additional, there's of course Power BI, Tableau, other systems that you can utilize if you have that. But that may be, if you don't have it already, that would be maybe difficult to deploy. But I think that came from Jarvin. Jarvin, I'm happy to kind of have a conversation with you offline as well on different ways that you can implement this, the data analysis, utilizing some of the resources that you have. What we're also seeing from a trend, we talked about, states and legalizing marijuana and cannabis, hemp. We're also seeing a huge push with now celebrities and investing in different cannabis companies, making it a little bit more difficult, I think, for financial institutions to really, detect these businesses and when their consumers are engaging with them. It's really going, I think once you have, celebrities committing to it, it then becomes pretty mainstream. And so we're seeing that as a trend, and where we're increasing financial institutions, essentially increasing their exposure to these businesses as well. Last year, the IRS had implemented a website or implemented a page on their website for marijuana specifically. And that was a huge indicator. A lot of people felt that from a federal perspective of what was going to happen in the future with marijuana. Of course, it's still federally illegal, but the IRS is collecting taxes still. So regardless if the state's position on legality, from a federal perspective, all income is still taxed. And so they now have a page on marijuana and all of the tax laws around it. So even though it's federally illegal. So with that, there was a lot of talk around the federal government really getting ready for legalization from a federal perspective. And I've included the website there for you, the webpage, if you'd like to take a look at it. But that was a significant change and towards the push for federal legalization. And then recently in February, we had our what's being called the first example of a financial institution being hit with a penalty or a consent order for banking a cannabis related business. This credit union in particular was providing full services to dispensaries, full marijuana related businesses. The consent order is the first of its kind and really is requiring this credit union to increase their transaction monitoring around their marijuana related businesses. They're no longer able to cease or able to onboard new marijuana related businesses. The transaction monitoring has to include a look back to identify any missed suspicious activity reports, and also includes a third-party review to ensure that their transaction monitoring that's in place and the changes that they've made are adequate, and to ensure that they've identified all missed SARs appropriately. There's also impact to their MSB program, which I found very interesting. There's a lot of talk on where the connection was made between the MSB and the MRBs in the consent order, but they're also not able to onboard any more MSBs, and they're also required to do that same look back from the transaction monitoring perspective for their MSBs. So where we've been talking about this for quite some time, based off of the FinCEN guidance, we did not see where a financial institution actually had any issues with complying outside of maybe an exam finding, but certainly not a consent order. And so this is the first one of its kind, and very interesting to see what brought it on and what the requirements were to comply without having true exam procedures around being able to bank MRBs. This was, a consent order is your next best thing for really understanding what examiners are looking for and what their expectations are, and where the line is drawn for them.
Nicole, we did receive a risk assessment question. So in regards to the risk assessment update, is it a regulatory requirement to update when risks change? Currently, we update annually regardless of change, but never annually. And the FFIEC manual states that, however, there's no requirement to update the BSA AML risk assessment on a continuous or specified periodic basis.
Yeah, so that's the new language that was included. The requirement, there was really never an annual requirement. That was just a best practice rule of thumb, if you will. And then when the FFIEC manual was updated last year, this was the new language that they put in. So really pushing that there was no specific timeline for the risk assessment. But then it does say later on in the exam manual that the requirement is to update it when your risks change. And that's really when you have a significant change in risk. So depending on the methodology that you're using for your risk assessment, if you are including, for example, volumes of certain customer types or certain transaction types, that's expected to increase. I wouldn't say you need to update your risk assessment every month because your risk has changed because you've increased, your consumer base, but if organically. But I think any significant risks that have changed, so again, a new product or service that increases your BSA risk, So a new way to move money, I would say, would require your risk assessment to be updated. Any mergers or acquisitions or changes in your geographic location, maybe that's digital banking, maybe that's a new location. Maybe now you're in a higher risk geographical area like a HIFCA or a HITCA where you weren't before. Those are major impacts to your risk assessment that I would recommend that you update as soon as possible rather than waiting for if your internal policy is to update it annually. I think there was another question that came in about, is it recommended to have a separate policy for MRBs or incorporate the language into the existing BSA AML policy? It's not, there is no specific recommendation that's come out about having a separate policy for MRBs. What I typically see is my clients that do provide those services is that they do have a separate policy for them. It needs to be in your BSA policy, of course, where it's spoken to, but then I see a separate manual or procedural document that really goes into a lot of the controls and requirements and expectations for the program separately. I also see an additional risk assessment that's completed separately, but then if you are doing that separately, it needs to be incorporated into your main risk assessment in your main BSA policy. You can certainly incorporate that into your BSA policy directly and not have a need for a separate manual. But I think I believe the reason why we have separate manuals is because of the heightened scrutiny around it and being able to make changes to it without having it go to the board for approval. And with that, we have our next polling question. Taking a look and seeing if you are serving the cannabis industry. And while you're all answering that, I'm going to jump into our executive session and start talking through about data analytics and the impacts that we're seeing for financial institutions where you can already utilize data analytics. So we're seeing it in risk management, and I think this is probably one of my favorite places where I'm seeing data analytics really incorporated. We're seeing that with interest rate risk, compliance risk, and credit risk, really being able to utilize analysis and some automation to really help mitigate the risks around these areas. I'm seeing it within risk assessments. There's a huge push right now for risk assessments. I'm seeing examiners really requiring and asking banks to implement different methodology for their risk assessment where it's not just qualitative, but also quantitative. They want to make sure that it's consistent and not that quote unquote gut check where you're saying this is medium or low or high because that's kind of how you feel, but they want to see the data behind it. They want to see why this makes sense for you, and that methodology is being applied consistently across the risk assessment. So we're seeing a lot of data analysis applied there where you're looking at trends, whether it be growth trends, any issues that you've had within audits or exams, looking at volumes and how that impacts your risk. So seeing all of that and then having that quantitative approach to identifying the risk scores for each risk area. We're seeing, again, examiners are really focused in on that. They were focused in on that in 2020, and we expect that to continue through 21. Performance analytics, great thing, for board sessions as well, taking a look at profitability. This kind of goes into really having that predictive feature to your products and services and how you're implementing them if you're bringing in that technology, seeing where you're profitable, what makes more sense for you to be deploying your resources to seeing what your consumers are looking for and asking for in their services and what they're willing to pay for. Goal setting, and then of course customer trends also plays into that. Well, we're seeing data analytics being utilized for historical analysis as well. Really being able to identify areas of improvement I've seen have the greatest impact here. And then bringing that into your strategic planning as well. So this analysis, bringing that again to the board level, has been a great improvement on how boards are interacting and their responsibilities within the bank. And we're seeing that being carried through executive dashboards. So we're seeing where board members and executive management are really being engaged on a new level with dashboards that they're able to interact with, where you have the data visualizations, they're able to have information to be able to make decisions. And the board reporting is just kind of really taken to the next level, and examiners have really been pleased seeing that being incorporated. And then of course, kind of going into profitability a little bit more, sales metrics, targeted marketing, your customers' products and services, having that analysis behind, you're no longer making assumptions. When we talk about data analytics, often it's referred to as this is your reality. The numbers don't lie, so being able to make decisions that are supported with analysis and assessment just helps to increase, your board involvement, executive management, decision making, really being able to be strategic and thoughtful in any changes that you're making, how you're spending your resources, and what products and services and new markets you're going to go into. Flipping into board reporting, really focused in on BSA, AML. I've often asked my clients what they should be reporting to the board. I spoke to this a few slides ago. I just wanted to repeat it because I think it's so important. The board has a responsibility under BSA, AML. In order for them to meet those responsibilities, they have to be able to not only understand BSA, AML rules and regulations, which is what I typically see in annual training for the board. They need to understand how that impacts the financial institution that they're serving. What are the risks that that institution has? How are they mitigating those risks? Are they doing enough? Are they comfortable with the remaining risk? If not, what resources are needed? In order for them to make those decisions and to really provide oversight, they need to have information that's coming to them, and not just during annual training. And so ensuring that your board reporting is thorough is paramount to how they're functioning in their responsibility for their board oversight. And so here I have a few ideas for you, things that I typically see, making sure that that's incorporated into your board reporting that typically I see quarterly, if not monthly. Really focus in on where your risks are, bringing in any outlooks, any anticipations that you have, whether it's talking about the new AML rules, even though we know that we don't even know what the exact rules are going to be, start having those conversations with them now. A huge focus for the new AML rules is on technology. And if you don't have that technology in place, start thinking about how you're going to be able to onboard that. Start now, start the planning process now, start having those conversations with them on the expectations that are going to be coming down. We don't know what the rules are and how things are going to be expected to be executed, but we do know what a lot of the end results are going to be. And so making sure that you are communicating that with the board really helps start putting that into place. And I think examiners coming in are going to see that within your board reporting, and they are going to like that you've already started the planning process, that you are being ready for the changes that are coming. They're going to be looking for that. I also wanted to talk about, I know we're running out of time a little bit, but hotspots and exam preparation tips. Kind of looking back at some of the things that we talked about, incorporating data analytics within the resources that you have to ensure that you have an adequate program in place. Handling of PPP, they're going to be looking at that regardless. Again, if you're a lender or not, they're going to be looking to see that you've incorporated that into your transaction monitoring. Risk management is a huge hot topic for examiners. I think the trend has been they're moving away. Of course, there's a lot of fixed hard rules within BSA like CTR and SAR reporting thresholds. But with the exam manual changes of last year, they're going to really be focusing in on your audit, relying on that for those more technical areas. And they're going to be spending more time on your risk management, what the results are. Again, focusing in on the suspicious activity reports that you've been filing, your risk assessment. Have you identified all your risks adequately? Is your board comfortable with the remaining risks? Are they supporting the resources that you need to mitigate those risks? Looking at transaction monitoring tools that you have in place. If you have a model, is it out of the box? Have you made any changes to the parameters? Do you have any supporting analysis behind those changes? What we've seen a trend there, I would say throughout the last little over a decade with transaction monitoring systems, it went from, do you have a transaction monitoring system in place, to great, you do, what are your parameters? And now it's, okay, you have these parameters, why do you feel that they're appropriate for you? And with that question, I often get my clients coming back to me saying, do you think this is wrong that I have the parameters set at this? And I'm like, no, they're not saying it's wrong either. They're asking you why you feel like it's right. They're not there telling you it's wrong, but you need to understand why you've set it that way and why that's appropriate for you. And then, of course, the board and management oversight. It's constantly, we see it in consent orders, and that it comes down to the board, and they're always looking for increased, that's always part of the consent order, is increased board participation, increased board and management oversight. That starts with the BSA officer, the BSA department, providing the information to the board so that they can fulfill their responsibilities. And so with that, I think I've left you all with 1 minute for additional questions. But if I've hit on anything, and it was a bit of an overview, if I've hit on anything that you would like to discuss further, please feel free to reach out to me, and we can have a one-on-one conversation that's unique to your institution, the way that your BSA AML program should be.
Thank you, Nicole. And thank you all for joining us. We hope that you found this session to be informative. You will receive this presentation materials next week, as well as your CPE certificate within the next 3 weeks. If you do have any questions, please feel free to reach out to myself, Nicole, or your contact on Bonadio's or Elliott Davis's financial institutions. And keep a lookout for future webinars. And if you haven't subscribed to our email updates and newsletters from us, please do. You can do that by visiting our email preference center on our website at bonadio.com. Thanks again, and have a great day, everybody.